Hey everybody, and welcome back to Sip and Talk.
Great to be here.
Today we're digging into the latest on Trump's tariffs, the economy, all that good stuff. We've got market data, some updates on trade talks.
Right. Some interesting signals about the real world effects, especially looking towards China.
Yeah, our mission, as always, is to kind of cut through the chatter and figure out what's really going on. What are the key things to watch?
Exactly. Filter out the noise, find this signal.
Okay, so first up, the markets. They've been looking pretty optimistic lately, haven't they?
They have, yeah. We saw those strong non-farm job numbers, which was a bit of a surprise, maybe.
Definitely. And stocks had a great week. S&P 500, Dow, NASDAQ, all hitting new highs. It almost makes you feel like, okay, maybe things are fine.
Well, it's an interesting contrast because remember, the Q1 GDP figures actually show the economy shrinking a little bit.
Right. That's the puzzle, isn't it? How can the job market be so strong, employers hanging on to people if the overall economy isn't, like, booming?
It's a disconnect people are definitely talking about. Why hold on to staff if growth is slowing?
And it's not just jobs.
Yeah.
The big companies, the S&P 500 ones, their earnings reports are pretty decent too, right?
Surprisingly good, yeah. A lot of them beat expectations for Q1, and overall earnings growth was positive.
So you'd think, okay, strong jobs, good earnings, that explains why the market's up. Case closed.
You'd think.
Yeah.
But there's some analysis floating around that suggests these short-term market swings, they might not be tightly linked to the fundamentals anymore.
What, like not linked to earnings or economic data or even the Fed?
Exactly. This particular analysis argues that things like, well, Trump's social media posts or even just vague statements he makes can have a huge impact on stock prices. Some estimates put it as high as like 95% influence.
Whoa, wait, 95%? Seriously? Just from like a tweet or something?
That's the claim. It's pretty wild, I know. And the concern isn't just, oh, the market's volatile. It's more about, well, the analysis calls it misplaced faith and lost judgment. If the market's moving that much based on non-economic stuff.
Yeah, that feels unstable. Like it's built on sentiment, not substance.
Potentially. It adds a whole different kind of risk, beyond just normal ups and downs.
Okay, shifting gears a bit then. Let's talk China. There's been news about factory closures over there. What's the story?
Yeah, we're hearing reports of a significant number of factories closing down in China.
And that's tied to the trade friction, the tariffs.
Directly linked, according to these sources. The U.S. tariffs are being cited as a major factor, and some folks are saying this might just be the beginning.
Just the tip of the iceberg. Wow, that sounds like a pretty direct consequence playing out.
It could be a sign of a bigger economic shift happening because of these policies.
Okay, so let's zoom out again. Trade negotiations. What's the overall Trump strategy looking like these days?
It seems pretty consistent with what we've seen before. He really emphasizes being the one in control, setting the terms, setting the tariff numbers.
Right, the whole we've been taken advantage of for years angle.
Exactly. That belief is central, that other countries need to adjust to fairer terms from his perspective.
And specifically with China, what's the status?
Well, according to what we're seeing, he's basically said there are no dealings with China right now because the tariffs are so high.
So the tariffs are the roadblock to talks, in his view.
He frames it more like the tariffs are the result of past issues and claims they've actually saved billions of dollars. It reinforces his long-standing position on China trade.
Okay, so high tariffs, no talks for now. What about other countries? We saw something about U.S.-Taiwan trade consultations.
Yeah, the first round just finished up. Taiwan's Vice Premier Chang Wen-san led their side.
And anything interesting come out of that?
Well, one notable thing was the new Taiwan dollar. It saw what was described as a violent appreciation right after the talks.
Violent appreciation. That sounds dramatic. What's that mean?
Just means its value shot up really fast and significantly against other currencies. It sparked some speculation. Maybe they discussed exchange rates.
Ah, like the U.S. pushing for a stronger Taiwan dollar.
Possibly. Or maybe just less intervention from Taiwan's central bank to keep it weaker. We don't know for sure, but the currency move was sharp.
And Taiwan's also under pressure on other things, right? Non-tariff stuff.
Right. Things like access for U.S. beef, offal, the less common cuts.
Gotcha.
And also quotas for rice that might be dumped, sold cheaply, and just general U.S. beef access. Plus, they're always balancing this against competition from Japan and South Korea.
Okay, so a lot going on with Taiwan. What about Japan? I heard those talks hit a bit of a wall.
Yeah, the second round of U.S.-Japan tariff talks reportedly stalled. The main sticking point seems to be tariffs on imported cars.
Cars again, that's always a big one.
It is. Japan's negotiator, Taro Aso, admitted they didn't reach a consensus on cars, but he still said the overall talks were positive. So progress elsewhere, maybe.
So different issues, different pressures on different countries. Is there like a bigger pattern here?
Some analysts think so. They call it a potential divide-and-conquer strategy.
How so?
The idea is Trump pressures each country individually for specific things the U.S. wants, like maybe currency appreciation from Taiwan, pushing Japan for lower tax rates, maybe getting South Korea to invest more in U.S. industry, all aiming for those reciprocal tariff rates he talks about.
Right. Deal with them one-on-one to get concessions. Makes a certain kind of sense. Now, switching back to cars for a sec, there was a point about the U.S. auto industry. Even if U.S. tariffs on imported cars go down, prices here might not.
Yeah, that's the interesting wrinkle, because even car companies building cars in the U.S., think Nissan, Subaru, plants like that, they still rely heavily on parts coming from overseas suppliers.
The supply chain issue.
Exactly. So even if the tariff on the finished car imported from, say, Japan goes down, if the tariffs on the parts coming from elsewhere stay high, or if those parts just cost more,
the total cost to build the car in the U.S. goes up anyway.
Right. Which could mean the price you pay at the dealership doesn't fall and might even increase.
So headline tariff cuts don't always equal consumer savings. Got it. Okay, looking even broader now. International politics. There was a mention of election results elsewhere potentially impacting trade talks.
Yeah, it's an observation some are making. We've seen recent elections, like in Australia and Canada, where the parties or leaders who won are maybe seen as opposing Trump's style or his focus on unilateralism.
Like Australia's Labour Party getting re-elected, Canada's Liberals under Trudeau.
Exactly. Leaders who've been critical in the past. The idea is this might be a factor the U.S. has to navigate in trade deals, a bit less global appetite for that approach, perhaps.
Interesting dynamic. Okay, let's talk about a huge name. Warren Buffett. Big news, he's planning his retirement.
Yeah, stepping back from the day-to-day CEO role at Berkshire Hathaway. Likely before year-end. The transition to his successor, Greg Abel, is already happening.
Still involved, but passing the reins. How's Berkshire actually doing right now?
Well, Q1 showed a big net profit overall. But interestingly, they had a net loss on their investments for the quarter.
A loss on investments. For Buffett.
Yeah, markets fluctuate. But the really eye-popping number is their cash pile. It's hit a record high. Just a massive amount of cash sitting there.
Wow. Why so much cash? Is he just not seeing anything worth buying?
Seems that way. He actually sold more stock than he bought in Q1 and hasn't made huge purchases since late 2022, really. It suggests he's probably waiting for better valuations.
Lower prices, basically. The Oracle playing it cool.
Seems like it. Waiting for a pitch he likes.
What's his view on all these tariffs we've been talking about?
Oh, he's been very outspoken against them.
Yeah.
He fundamentally doesn't think trade should be used as a weapon.
Okay.
And he's also voiced serious concern about any government actions that could devalue the currency, the dollar. He called that a terrifying thing.
Strong stance. But he does expect to use that cash hoard eventually.
Oh, yeah. He said he expects Berkshire will deploy a lot of that capital within the next 5 years. He sees opportunities coming.
And he's still putting money into Japan, right? Even with their rate hike.
Yeah, still investing in those Japanese trading houses. Seems he's leveraging the still relatively low borrowing costs in yen, even after the Bank of Japan moved rates up a tiny bit.
Smart strategy if he can make it work. What about the Buffett indicator, that market cap to GDP thing? Where's that sitting?
It was pulled back a bit recently, which is good if you're looking for value, but it's still way above the levels where Buffett historically got really interested. So by his own measure, the market, while maybe less expensive than it was, isn't exactly cheap yet.
Still looking kind of pricey through his lens. Okay, let's pivot to a few other quick hits from the news flow. Trump's heading back to D.C. soon.
Yeah, he mentioned a return coming up and said he'd have good news, especially about what he called many war zones created by Biden and a group of incompetents.
Okay, typical rhetoric there. What about the National Security Advisor shuffle?
He framed that change as an upgrade, not a reflection on the person leaving. Said it was a strategic move to put that individual at the UN.
That's right.
He dismissed media criticism and said the permanent replacement will be named within 6 months or so. He floated names like Stephen Miller, calling him very valuable.
Miller, okay.
And also mentioned Marco Rubio as maybe being considered for a permanent role down the line.
Interesting possibilities. And judicial appointments, still a big focus.
Huge focus. He talked about the rapid pace of nominations, wanting judges who, and this is his quote, do not demand a trial for every illegal immigrant.
Implying some judges do.
He called that requirement impractical, labeled judges who insist on it radical and crazy. He linked it all back to immigration being the #1 issue, claimed he won overwhelmingly because of it, and expressed frustration with judges mostly appointed by others he claimed blocking deportations of people he called murderers.
So very strong views on judges and immigration enforcement. And then finally, this point about potentially sending U.S. troops into Mexico.
Yes, he confirmed that's something being seriously considered, to go after the drug cartels. He called the cartels terrible people, blamed them for, he cited 300,000 fentanyl and drug deaths last year, said they're destroying our people.
And he offered to help Mexico.
Yeah, said he'd help Mexico if they need it.
Yeah.
While also describing the Mexican president, who is actually a woman, by the way, as lovely, but suggested she's so afraid of the drug cartels that she's unable to think straight.
Okay, that's a lot. Sending troops into another country? Big implications there.
Huge. Very controversial idea.
So just to kind of wrap this all up, we've got markets maybe moving on vibes as much as fundamentals.
Yeah, potentially.
Complex, ongoing trade tensions and negotiations, especially with China, but also key allies.
Right, the divide and conquer aspect, potentially.
And this backdrop of global political shifts and some pretty dramatic policy proposals being floated.
And don't forget those China factory closures. That feels like a really concrete data point to watch, you know? A possible sign of deeper shifts.
Absolutely, a tangible consequence. So maybe the question to leave everyone with is this. Looking at all these moving parts, the trade stuff, the weird market behavior, the global dynamics, what are the longer-term consequences we should really be thinking about?
Yeah, and what's the sleeper issue? What's the factor we're maybe overlooking right now that could suddenly become really important down the road?
Exactly. Lots to chew on there.
We'll be right back. Don't go anywhere.
Yeah.
I just want to give another shout out to Micky from Mickytolife. His channel is a treasure trove of inspiration, and he's a huge Sip&Talk fan.
Absolutely. Make sure to check him out and maybe even share your awesome podcast intro with him once you've created it. This is where we take all that juicy info you send us, articles, studies, those YouTube rabbit holes, and really squeeze out the good stuff for you.
Think of it as your fast track to being seriously informed.
Yeah, without the brain melt. And this deep dive, it's specially brewed for you, the learner, the curious ones wanting to get smart quick but get the real story.
That's right. We're diving into some pretty fascinating currents in the global money world today. Our listener flagged some key areas they really wanted to understand better.
So what's on the menu? First, something, unexpected involving DOGE.
Yep, DOGE. No, not the coin, though. Something different.
Exactly. Then we're chasing the shiny stuff gold. Who's buying it like crazy? And why China seems to be on this major gold rush. Trade wars. Something else.
We'll dig into the potential reasons.
After that, we're going to try and peek inside Warren Buffett's mind, figure out what his recent kind of quiet moves might be signaling.
Always interesting to see what he's up to, or rather not up to.
Totally. And finally, the big what if, what happens if China's economy, hits a wall, a hard landing.
The potential ripple effects are huge.
It's all connected, folks. So let's dive in.
Absolutely. Let's start with DOGE.
Okay, yeah, let's kick things off with this DOGE story. Now, when I first saw Doge, my brain immediately went to the meme, the Shiba Inu.
Yeah, understandable. But this is different. It's a team, capital DOGE. And they're doing some serious digging.
Into what, exactly?
Their focus is unmasking U.S. government waste and fraud. So it's all about how taxpayer money is being spent or maybe misspent.
Right, accountability. And get this, Elon Musk invited them to the Eisenhower Executive Office building.
Which is, pretty high-level access. It suggests their findings are getting some attention.
No kidding. So what kind of stuff have they uncovered? Sounds like it's pretty wild.
It really is. Some of the examples are quite startling. Take the COVID-19 education funds. $4 billion.
Okay.
Apparently, a chunk of that was used for things like a party at Caesar's Palace, renting stadiums.
Seriously?
Largely because there wasn't a solid requirement to keep receipts for certain spending. It shows a staggering lack of oversight.
Wow. That's, almost unbelievable. Sounds like something out of a movie.
But the Doge team suggested a simple fix. Require receipts.
Makes sense.
And apparently the funding request dropped significantly after that. Sometimes the simplest solutions work.
Huh. You'd think that'd be standard practice. What else?
Then there were small business administration loans. About $330 million went to individuals listed as being over 120 years old.
Wait, what? Over 120?
Or with impossible birth dates, like, 2165. Things that a basic data check should have caught instantly.
That's just sloppy. Did anyone even look at these?
It certainly raises questions about the vetting process. And it gets, well, stranger. They looked into funds for projects like Peru alpaca farming.
Alpaca farming.
And Guatemalan peas, saving the red panda. Noble goals, maybe, but the money often didn't reach the intended recipients.
So where did it go?
Well, in one case involving the Inter-American Foundation, only about 58% reached the people it was meant for. The GAO estimated sometimes only 10-15 cents on the dollar actually got to the end beneficiaries.
10 cents?
And that alpaca money, apparently much of it never even left D.C.
So the money got stuck in the pipeline, basically. Lost in the bureaucracy.
Exactly. And speaking of bureaucracy, the U.S. Institute of Peace, or USIP, sounds tranquil, right?
Yeah, you'd hope so.
But the Doge team described it as the most uneasy institution they dealt with. They found some serious issues.
Look what?
Use of funds for private planes, a $130,000 contract for vague services with a former Taliban member.
Whoa, okay, that's something.
And loaded guns found in their headquarters.
Loaded guns?
Yeah.
At the Institute of Peace?
Yep. Plus, the chief accountant allegedly deleted over a terabyte of accounting records.
Oh, come on. Isn't that illegal?
It certainly raises serious legal questions. The Doge team managed to recover the data, remarkably.
Yeah.
And then there was the issue of unused congressional funds being moved to an unsupervised private bank account.
Unsupervised. So basically, a slush fund.
The potential for misuse was definitely there. It points to major oversight gaps.
And has anyone faced consequences? Arrests? Anything? Especially for deleting records.
The sources indicate the evidence about USIP's accounting was given to the FBI and DOJ, but they don't mention any arrests or convictions resulting from these specific revelations.
So zero accountability, it sounds like, despite all this digging.
That lack of accountability is a major theme. The team pointed to the sheer complexity, the bureaucracy, the layers of subcontractors making it incredibly hard to track fraud or even just progress.
Yeah, like wading through molasses. It's interesting the source mentioned President Trump had an executive order targeting agency reduction, and USIP was on that list.
It does suggest maybe some awareness of potential issues at higher levels.
Right, and that weird resignation program, Crossroads, 8 months pay to leave.
Yes, offering 8 months of pay and benefits.
Yeah.
But interestingly, there was initial resistance to it, even though it sounds like a good deal.
Which just shows how resistant to change these places can be.
It really does. And the Doge team, they see this as a long game. They believe without constant oversight, this kind of waste and fraud just creeps back in.
Depressing, but probably true. Constant vigilance needed.
It highlights the need for independent scrutiny, definitely.
Okay, wow. That was quite the detour into government spending. Let's shift gears to something shinier. Gold.
Right, gold. There's been a lot of talk about who's buying it, and China's purchases have been particularly massive.
Why the sudden gold fever, especially in China? The sources mention the trade war, right?
That's definitely part of the picture. Research suggests China is buying gold partly as a hedge, a buffer against economic uncertainty, especially from the trade tensions with the U.S. Those tensions can impact their growth, asset values.
So gold is like financial insurance. If the economy tanks, gold holds up.
Pretty much. It's a classic safe haven asset. But central banks buy gold for other reasons, too. Diversification is a big one.
Meaning not keeping all their reserves in U.S. dollars.
Exactly. Reducing reliance on the dollar. Gold also acts as a hedge against inflation, and it has that deep cultural significance, especially in places like China.
Makes sense. Got any numbers on who's buying the most?
Yeah, the data for the decade leading up to 2024 is quite striking. Russia and China were the top central bank buyers by far, over 1,200 tons each.
Wow. 1,200 tons, that's a lot of gold bars.
It is. Turkey was third, but significantly behind them. And the People's Bank of China, the PBOC, kept adding to those reserves consistently into early 2025.
So the buying continued?
Yes, and they also made a policy change in March 2025, allowing Chinese insurance companies to trade gold. That signals they want to support gold investment demand domestically long-term.
So it's not just the government, they're encouraging others to buy too, and regular people.
Right. The sources mention rising consumer interest in gold in China as well, adding to the demand.
Okay, so let's connect the dots. Trade war first. How does gold help there? Could they, crash the yuan to fight tariffs?
Well, they could let the yuan depreciate moderately to make their exports cheaper, offsetting some tariff impact. They did a bit of that in 2018-19. Gold acts as a reserve asset that's not tied to the dollar, giving them more flexibility.
But the sources said a massive devaluation, like what happened with the Russian ruble, is unlikely for China. Why not?
Several key reasons. One, it risks massive capital flight money pouring out of China, destabilizing things. Two, many Chinese firms have dollar debt, which becomes crippling if the yuan tanks.
Ah, okay, that makes sense.
Three, it invites international backlash, accusations of currency manipulation. And four, the PBOC generally prefers stability. They have tools to manage the exchange rate, usually keeping it in a relatively tight band, like around 7.0, 7.2 to the dollar in early 2025. They use interventions and capital controls.
Okay, so managed depreciation maybe, but not a free fall. What about the war risk angle, like tensions over Taiwan?
Gold serves as a hedge there, too. In a high-risk scenario, you could see currency pressure and capital flight. Holding gold provides a buffer, a store of value independent of the geopolitical situation. Think of how Russia leaned on its gold reserves after sanctions hit and the ruble fell in 2022.
Right, a financial backstop. But again, why is China different from Russia here? Why less risk of a ruble-style collapse?
Fundamentally, China's economy is vastly larger and more integrated globally. They have enormous foreign exchange reserves, about $3.5 trillion in 2025.
$3.5 trillion. Okay.
Their trade is more diversified, and crucially, they have much stricter capital controls, limits on foreign exchange, monitoring outflows. These have been effective before, like in 2015-16.
And those controls make it hard for money, even for big companies, to just leave.
Exactly. The difficulties companies like Apple and TSMC face shifting supply chains partly reflects how effectively China can manage capital flows when it wants to.
Got it. So summing up the gold rush, it's partly a hedge against trade war and geopolitical risks causing currency wobbles, but also a longer-term strategy.
Yes. Building financial resilience, diversifying away from the dollar, hedging inflation, plus the safe haven appeal. And importantly, they have the reserves and controls to likely avoid a truly drastic currency collapse.
Okay, that makes a lot more sense. All right, let's pivot again. The Oracle of Omaha, Warren Buffett.
Always a fascinating subject.
A listener pointed us to a YouTube video. Warren Buffett just sent a powerful message. What's the message? What's he signaling?
The video argues that Buffett's recent actions, mainly selling stocks and holding tons of cash, suggests he's cautious about the current market. Maybe even thinks we're facing a lost decade for stocks.
A lost decade, meaning like zero real returns for 10 years?
Essentially, yes, after accounting for inflation. The video draws strong parallels to his moves right before the dot-com bust in the early 2000s.
And you really don't want to bet against Buffett's long-term calls, historically speaking.
It usually doesn't end well for those who do. So what's he actually done? Berkshire Hathaway's filings showed they sold over $130 billion in holdings during 2024.
Billion with a B.
Wow. Yep. Which left them sitting on over $341 billion in cash by early 2025. That's more than a third of the company's entire value, just sitting in cash or cash equivalents.
Holy cow, and he's not reinvesting it.
Apparently not in stocks. The interpretation is he doesn't see good deals, good value at current prices. He's not even buying back much of Berkshire's own stock, which is telling.
So where's the cash parked?
Mostly in short-term U.S. Treasuries, T-bills, earning a decent, safe yield, maybe 4 or 5%. That's generating billions in profit just from holding cash safely.
Smart. Low risk, decent return while you wait. And the video compared this to 1999.
Exactly. Back then, during the dot-com mania, Buffett was doing similar things, holding cash, warning in his shareholder letter that stock prices were way too high, detached from fundamentals. He explicitly predicted low returns for the coming decade.
And people called him a dinosaur, right? Out of touch.
They did. He got a lot of flack. But of course he was right. The market basically went nowhere in real terms from 2000 to 2012. His lost decade prediction came true.
So the parallels are holding lots of cash, not buying stocks, not even buying back his own shares. Just like 99.
Pretty much. And the video brings up other warning signs Buffett watches, like the Buffett indicator.
Oh, yes, the market cap to GDP ratio.
Right. Total U.S. stock market value divided by the country's GDP. He calls it the best single measure of valuation. In 2000, it hit 140% before the crash.
And now?
The source said it was at 177%, significantly higher than the peak before the dot-com bust. Suggests the market is pretty pricey compared to the overall economy.
Oh, yes. Okay, 177%. That's high. What else?
The SAPE ratio, or Shiller PE ratio, That looks at current prices relative to average inflation-adjusted earnings over the last 10 years.
Another valuation measure.
Exactly. Historically, it's been good at flagging bubbles like in 1929, 1999, 2008. A reading over 15 or 16 is considered high.
And now, don't tell me.
Around 33. More than double the historical average. So another indicator suggesting frothiness.
Okay, so multiple signs pointing towards an expensive market. The video mentioned Buffett's Cinderella at the ball metaphor from '99. How does that fit now?
It describes the feeling that investors know things are risky, maybe getting late in the game, like Cinderella knows she has to leave the ball at midnight, but they don't want to leave the party too early.
They want to keep dancing, keep making money in those hot tech AI stocks.
Right, hoping to time their exit perfectly just before the clock strikes 12 and things turn ugly. But Buffett's point was, the clocks in this ballroom have no hands. You don't know when midnight is.
Huh? Great metaphor. And impossible to time it perfectly. So Buffett's strategy now isn't trying to time it.
No, he's not even on the dance floor. He's sitting it out, patiently holding cash. Just like he did before 2008, before the dot-com crash, waiting.
What's his playbook when things do turn down?
Maintain that strong cash position, his dry powder. Be patient and disciplined. Wait for what he calls a spring blowout sale where great businesses go on offer cheap.
Like in 2008 when he bought into Goldman Sachs?
Exactly. He deployed about $20 billion then into beaten-down companies. He's not trying to catch the absolute bottom, just get enough for his money. Good value.
And Charlie Munger's quote, something about waiting.
Right. Munger said, the big money is not made when you buy or sell. It's made in the time you hold and wait. And more recently, he said the wise investor bets big when the odds are overwhelmingly favorable. And the rest of the time, they basically do nothing.
Wait for the fat pitch. So for us regular folks, the takeaway is...
be realistic, don't panic, but don't get swept up in euphoria either. See Buffett's inactivity as a sign that maybe value is scarce right now. Be patient.
And maybe build up some cash.
Exactly. Build your own dry powder by saving more or cutting costs so you're ready if or when better opportunities arise. Prepare, don't predict.
Good advice. Okay, last big topic, the China what if. What if their economy takes a real dive, a hard landing?
Yeah, that's the scenario analysts consider. A sharp slowdown, maybe triggered by the real estate market troubles, weak consumer demand, or even escalating geopolitical tensions.
Hasn't growth already been slowing?
Yes. The World Bank noted a slowdown from 5% in the first half of 2024, projecting maybe 4.8% for the full year. Weak domestic demand and the property slump are key factors.
And if it gets worse, a hard landing. That would hit U.S. companies pretty hard, wouldn't it? Especially those really reliant on China.
Absolutely. The impact could be significant. The sources identified companies with the highest revenue exposure to China.
Who tops the list?
Qualcomm gets about 2/3, roughly 66.6% of its revenue from China, heavily dependent on their smartphone market.
Wow, 2/3.
Micron Technology is also very high, around 57%. China's a massive market for memory chips.
Okay. Anyone else significantly exposed?
Intel, around 27%, Tesla, 26%, Nvidia, 26%, and Apple, 17%, were also mentioned as companies that would feel the impact, though maybe less dramatically than Qualcomm or Micron.
So a hard landing means potential trouble for their sales, profits, operations.
Definitely. But it also triggers broader global effects. Decreased global demand overall, potential supply chain disruptions again, financial market volatility.
More uncertainty.
Right. Specific market risk for companies banking on Chinese consumers, like Wynn Resorts too. And potentially increased geopolitical risk, maybe U.S.-China trade tensions flare up again, more tariffs, tech restrictions.
And maybe contagion to other emerging markets?
Yes. If China's demand for commodities drops, that hits commodity exporting emerging economies hard.
Okay, so it's a big deal globally, but companies aren't just sitting ducks, right? The sources mention Apple and Tesla shifting supply chains.
Correct. It's a major strategic response. Apple, for instance, has reportedly invested $16 billion since 2018 to diversify its supply chain, moving more production to places like India and Vietnam.
$16 billion. That's serious. So less reliance on China.
That's the goal. Foxconn and other suppliers are involved. There's talk of moving all iPhone assembly for the U.S. market to India by the end of 2026. They've brought on new Indian suppliers like Tata Electronics.
Is it working? Are they actually reducing dependence?
It's complex. The proportion of Chinese suppliers actually ticked up slightly recently, but the overall direction is diversification. However, there are challenges. China might make it difficult to move equipment out, creating delays.
Potential roadblocks from Beijing.
Could happen. So while this de-Chinification might raise costs and hurt margins short term, the idea is it reduces long-term geopolitical risk and might boost investor confidence.
Makes sense. What about Tesla? They face tough competition in China too, right?
They do, from local players like BYD. That's already invoicing them. So they're also shifting parts of their supply chain, looking at India and Mexico. Plus, developing tech like rare earth alternatives to reduce reliance on Chinese materials.
But China's still a huge market for Tesla.
Absolutely. About 26% of their revenue. A hard landing there would definitely hurt demand and probably accelerate Tesla's diversification efforts. Again, short-term bumps, but expanding globally, like into India, could be attractive long-term.
So these shifts create opportunities elsewhere. Who benefits?
Definitely. India is a major beneficiary, driven by Apple and Tesla's moves. It's spurring manufacturing and infrastructure development. Investors might look at the Indian market, maybe ETFs or key suppliers like Tata.
Okay. India. Who else?
Vietnam. It's becoming a hotspot, especially for Apple's suppliers, due to lower costs and proximity. So it may be Vietnam ETFs or related Taiwanese firms with operations there like Foxconn subsidiaries.
And Mexico.
Mexico is also benefiting from parts of Tesla and Apple's supply chains moving closer to the U.S. market near shoring. Investment opportunities could be in Mexican manufacturing or logistics.
Got it. But there are risks too, right, with these shifts and investing in these other places?
For sure. Short term, the costs of moving supply chains could hit Apple and Tesla's profits, causing stock volatility. There's the risk of Chinese retaliation restricting exports or market access.
And risks in the new locations. India, Vietnam.
Yes. Emerging markets have their own challenges, infrastructure bottlenecks, maybe labor skill gaps that could limit efficiency. Investors need to assess those carefully.
So the bottom line on a China hard landing.
It poses real challenges, no doubt. But the supply chain shifts by major players like Apple and Tesla also create significant opportunities elsewhere.
So for investors,
it underlines the need for diversification, maybe hedging against short-term volatility, but also thinking longer term about positioning in emerging markets like India and Vietnam, focusing on companies set to benefit from this global supply chain restructuring. Flexibility is key.
Navigate the uncertainty, but keep an eye on the potential upside from these massive changes.
Exactly. It's about balancing risk and potential reward in a changing global landscape.
Wow. Okay. We covered a lot of ground today, from Doge digging up dirt to China hoarding gold, Buffett sitting on cash, and the whole world rebalancing supply chains.
We did. Hopefully this deep dive gives you, the learner, a clearer picture of these interconnected financial currents and strategic moves.
Yeah, the key takeaways seem to be China's playing a careful game with its currency and assets, gold's appeal is rising for strategic reasons, Buffett's flashing caution signs about market valuations, and a potential China slowdown has massive ripple effects, forcing big changes.
Well summarized. It's a complex picture, but understanding these pieces helps see the whole board.
Absolutely. Think about the device you're likely listening to this on right now. I mean, that amazing bit of tech. It didn't just appear, did it? It's the end result of this huge, interconnected global machine.
It really is.
And when one part of that machine sort of stumbles, the ripples, they can be felt absolutely everywhere, affecting massive companies, sure, but also individuals, like our friend Micky over in Taiwan, who might just hold some shares in a company like Apple.
That's exactly right. Yeah. The global economy isn't just, abstract numbers on a screen. It's a network of very real, very tangible dependencies. What could be a pretty significant stress test for that whole network. What if these ongoing economic headwinds in China, what if they actually lead to a hard landing?
Right. What would that fallout really look like? For the world, yeah, but maybe more specifically for a giant like Apple, and by extension, all its stakeholders, someone like Micky included. What exactly is a hard landing when we talk about China?
Well, in this context, a hard landing basically means a sharp, pretty significant downturn in China's economic growth.
Okay.
We're talking growth possibly dropping below 3%. Some analysts are even considering, the possibility of negative growth.
Wow. Negative growth.
Yeah. And there are several potential triggers. The real estate market is a huge one. New house sales were reportedly down, 30% in 2024?
30%, yeah, I saw that.
Then you've got weakened consumer demand, this sort of worsening debt crisis. Right. Local government debt is estimated at something like 70 trillion RMB.
70 trillion. That's yuan renminbi, right?
That's right. Huge number. And on top of that, declining exports. So it's a mix of factors.
That definitely sounds worrying just on its own. But why should the rest of us, outside China, be quite so concerned?
Well, it really comes down to China's sheer scale.
Yeah.
And just how deeply plugged into the global economy it is.
Okay.
Right now, China accounts for roughly 18% of the entire world's GDP. 18%.
Right. That's massive.
So any kind of substantial economic contraction there, it's almost guaranteed to send significant ripple effects right across the globe.
Okay, so China hits a wall, the world feels it. Got it. Now let's zoom in on Apple. It's this absolute behemoth of a company. We all know that. But what's their specific link to China, production-wise, for iPhones, other gadgets?
Oh, China is absolutely critical for Apple's production right now. As of, let's say, April 2025, the estimates are that somewhere around 80 to 90% of all iPhone assembly happens in China.
80 to 90%.
Yeah, it's still the vast majority. And this dominance, it's built on these enormous manufacturing ecosystems. You've got key players like Foxconn, obviously. They're placed in Zhengzhou. People call it iPhone City.
Yeah, iPhone City, right.
That facility alone handles maybe 70% of global iPhone assembly. Just think about that concentration. It really highlights the sheer scale of the operation.
iPhone City really paints a picture, doesn't it? And we're talking about a massive number of people involved in this, yeah.
Absolutely. Huge workforce. Back in 2023, Apple's main partners in China, Foxconn, Pegatron, Wistron, they employed over 1 million workers combined just for assembly and component production.
1 million people.
It's an immense operation. And look, while a lot of the high-value stuff, the really expensive bits like processors from TSMC in Taiwan, memory chips from Samsung, camera sensors from Sony, while they often originate outside mainland China.
Right.
It's really important to remember that many of those companies also have significant manufacturing plants inside China. Samsung, for instance, has a massive NAND flash memory factory in Xi'an.
Oh, interesting.
Yeah, it accounts for a big chunk of their global output. So this network of manufacturing, it goes deeper than just the final assembly.
So it's not just snapping the pieces together at the end. There's this deep layer of component manufacturing happening right there, too. And we're seeing more Chinese companies themselves becoming key suppliers now, aren't we?
That's right, yeah. Chinese firms like Sunny Optical, for example, they're playing a bigger and bigger role in the iPhone supply chain.
Sunny Optical?
Yeah. They reportedly became a major maker of the main camera lens, even taking over from some Taiwanese suppliers for that part. So the domestic capability is growing.
Okay. Now, for ages, the common wisdom, let's say, was that China's manufacturing edge was all about cheap labor. But based on what we're seeing, that's not really the main story anymore.
You're absolutely right. That's kind of an outdated view now. Labor costs, actually, they make up a pretty small slice of the iPhone's final retail price.
Really? How small?
Somewhere in the range of just 2 to 5%. Maybe $10 on a phone that sells for, say, $550 or more.
Huh. Only 2 to 5%.
Yeah. Some analysis, like one from Nikkei Asia, suggested China's actual value contribution to the iPhone is only about 2.5%.
Mm-hmm.
And that's mainly from lower value components in the assembly itself.
Right.
The really high value components, they make up maybe 80% of the cost, and they're coming from the U.S., Korea, Japan, Taiwan mostly.
Interesting.
And Tim Cook himself said back in 2023 that over 95% of Apple products were still made in China.
So despite what people might think, the main reason for being there isn't cheap labor anymore. It's really about the established infrastructure, the skills, and just the sheer scale of that ecosystem they've built up.
The infrastructure, the scale, the whole ecosystem, that's what keeps them there, at least predominantly. But we're also seeing this definite push from Apple to diversify its supply chain, move some production out. There's definitely a shift happening, albeit gradually.
Mm-hmm.
Several big factors are driving it. The ongoing trade tensions between the U.S. and China, that's a major one.
Sure.
Broader geopolitical risks, too, like, the situation around the Taiwan Strait.
Mm-hmm.
That's always a background concern. And, of course, the very real worries about China's own economic slowdown we were just talking about. All of that is pushing Apple to hedge its bets, basically.
Makes sense. So where are they looking? India and Vietnam seem to come up a lot.
They're the main ones, yes.
Yeah.
India in particular has become a really key location for this diversification effort.
How much are they doing there now?
Well, as of 2024, India is assembling somewhere around 10 to 15% of all iPhones.
Okay, 10 to 15.
And the projections suggest that could climb to maybe 15 to 20% by the end of 2025 and potentially even 25% by 2027.
25%? A quarter of all iPhones. That's significant.
It is. And you see in the export numbers, too.
Yeah.
Exports to the U.S. from India, they hit like $2 billion in March 2024 alone. That's a really rapid ramp-up. It shows a clear strategic shift.
That is a fast ramp-up. But it can't all be smooth sailing trying to replicate that Chinese ecosystem in India, right? What are the bumps in the road?
Oh, definitely not smooth sailing. There are absolutely challenges. Yield rates, for instance. That's the percentage of good units coming off the production line.
Right.
At some Indian factories, like Tata's Hauser plant, they're reportedly running around 50%, which is, well, it's significantly lower than what they achieve in China.
50%?
Yeah. Plus, there are issues finding enough skilled labor, getting the infrastructure fully up to speed compared to China's incredibly mature system. It takes time.
Okay, so India is growing, but with challenges. What about Vietnam?
Vietnam's definitely playing a role, too. They're handling about 20% of iPad production now, and a really substantial chunk of Apple Watch assembly, maybe 90%.
90% of watches? Yeah.
And they've even started some trial runs for iPhone production there, too. But the scale, for now, seems smaller than India. And you've also got things like potential U.S. tariffs on goods coming from Vietnam that need to be factored in. We're also seeing bits of Mac production shifting to places like Malaysia, but again, smaller scale. So, look, progress is being made on diversification, but moving a supply chain this complex, it's neither easy nor quick.
And what about the idea of bringing production back to the U.S.? That crops up in discussions sometimes. Politically popular, maybe?
Politically popular, perhaps, but it seems largely impractical from a cost perspective. The estimates floating around suggest that making iPhones in the U.S. could potentially push the price tag up to something like $3,000 per phone.
$3,000?
Yeah, which would obviously, completely change the market dynamics and demand. It really puts the whole global manufacturing cost structure into sharp perspective.
Wow, it certainly does. $3,000. Okay, so diversifying is slow, it's complicated, and haven't there been reports that China might actually be, trying to make it harder for Apple to move production out?
Yes, there have been reports suggesting things like that. Allegations that Chinese authorities might be delaying or maybe obstructing the export of critical trial production machinery to India.
Like what kind of machines?
Well, the kind of equipment needed to start producing early versions of, say, the iPhone 17. The idea is this could be an attempt to slow down the shift to maintain China's central role in the supply chain. There have even been whispers that Apple suppliers might need to use, like shell companies based in Southeast Asia, just to get around some of these potential restrictions. It's fascinating, really, this interplay between the economic pressures and the sort of geopolitical maneuvering going on.
Okay, so against this whole backdrop, China's iffy economy, Apple trying to diversify but facing hurdles, let's loop back to our main question. If China does hit that hard landing, what's the immediate hit to Apple's production look like?
Well, you'd likely see impacts in several key areas. First off, just straight up decreased demand for Apple products within China.
Right, the market itself shrinks.
Exactly. China is a massive market for Apple. It accounts for, about 20% of their global sales? That was around $80 billion in revenue in 2023.
$80 billion, yeah.
And we've already seen signs of weakness. iPhone shipments reportedly dropped 20% in China in early 2024. Apple even did those rare price cuts to try and boost sales.
I remember that, yeah.
So a real hard landing would obviously squeeze Chinese consumer spending power even further. Big-ticket items like iPhones, they'd likely be one of the first things people postpone buying. That hits Apple's revenue directly.
Makes total sense. Less money around, fewer iPhones sold. What about the making of the iPhones, though? Could a hard landing actually mess with the supply chain itself?
Absolutely. Think about those crises we mentioned, the real estate slump, the local government debt. Those could easily lead to funding shortages for crucial manufacturers, like Foxconn.
Ah, right. Their financing could dry up.
Exactly. That could impact their day-to-day operations. You could see production delays, maybe even temporary shutdowns if the financial pressure gets bad enough. And then there are other factors, too. Rising labor costs in China, which are happening anyway, combined with a potential shortage of skilled workers, partly due to the aging population, that could push Apple's production costs up even more, squeezing their profit margins. So it's not just demand. The ability to produce efficiently could also take a hit.
And we can't forget the whole U.S.-China geopolitical situation hanging over everything. How does a potential Chinese hard landing interact with those risks for Apple?
Yeah, that's a huge overlay. The U.S.-China trade war, or tensions, whatever you want to call it, it's a major factor. Right now, iPhones have an exemption from the really high potential tariffs, but that could change.
Those tariffs could go up to like 125% on some Chinese goods, right?
That's the potential high end being discussed, yes. Even now, there's still a 20% tariff related to some other issues, like fentanyl precursors. If those massive tariffs ever actually hit iPhones, Apple would be forced to accelerate its shift out of China even faster.
Or raise prices massively.
Or absorb the cost, which hits profits. And then there's the risk of retaliation from China's side. They could, for instance, restrict exports of things like rare earth elements, which they dominate and are vital for electronics.
Right, the rare earths.
And then there's Taiwan. Increased tensions in the Taiwan Strait. Some analysts, like at CSIS, wrote in a 2024 report about this idea of a peak power trap, where China, facing economic decline, might become more aggressive externally. Any conflict or major incident there would obviously cause massive disruption to regional supply chains, hitting companies like TSMC and, by extension, Apple. So you've got this nasty mix of economic and geopolitical risks feeding each other.
So it's this whole storm brewing, potentially lower demand, disrupted production, geopolitical heat. What about competition inside China? Is that getting tougher for Apple too?
It is, yeah. The competitive landscape there is definitely heating up. Local Chinese brands like Huawei and Vivo, they actually overtook Apple in market share in China in 2024.
Overtook Apple.
Really?
Yep.
It shows growing pressure. And a hard landing could potentially make that worse for Apple, as more consumers might opt for, more affordable domestic phone brands. It definitely raises big questions about Apple's long-term position in that absolutely critical market.
Okay, so yeah, a lot of potential headwinds for Apple there. Now, let's bring it back to our friend Micky in Taiwan, holding Apple stock, or maybe anyone listening who holds Apple shares. What are the likely consequences for stockholders if China goes through a hard landing?
Well, the most immediate thing would likely be stock price volatility. Serious volatility.
Okay.
Goldman Sachs put out an estimate in 2024 suggesting a Chinese economic crisis could potentially knock 10 to 20% off U.S. tech stocks, Apple included.
10 to 20%.
Yeah. And we already saw a taste of it maybe in April 2025 when Apple stock dropped about 9%, partly on those tariff worries we talked about. So volatility is almost a given.
Right. And beyond just the stock price bouncing around.
Well, major profit pressures. We touched on tariffs. Even without the huge 125% ones, if the current 20% stays or other measures kick in, or if they face those hypothetical massive tariffs, Apple either has to raise prices significantly, maybe by like 43% if the big tariffs hit, which kills demand, or they have to absorb those costs themselves, which would seriously bite into their, frankly, very healthy gross margins. They were around 46% in 2024.
46%, yeah. Squeezing that would hurt.
Definitely. And then, of course, just the falling demand in China sales were already flat there in 2024 before any potential hard landing. That directly hits their bottom line, their earnings per share.
Yeah.
So, yeah, investors like Micky could see a very real impact on their portfolio's value.
Those are pretty immediate financial risks. What about longer term, if this situation drags on?
Longer term, the risks get potentially even bigger. If, say, China were to really clamp down and restrict the export of essential manufacturing gear, or if Apple's efforts to shift its supply chain just didn't work out fast enough or effectively enough.
Right.
Then the company could face really prolonged production disruptions, not just a blip, but something sustained. In that kind of scenario, that could put serious long-term pressure on Apple's stock price. There was even a New York Times report in 2025 that speculated Apple's entire market cap could potentially be cut in half if it lost both its Chinese supply chain and its access to the Chinese market.
Halved. Wow, that's a drastic scenario.
It's a drastic scenario, but it highlights the potential scale of the risk for long-term investors if things went really badly wrong.
Okay. And thinking about Micky again, specifically being in Taiwan, how does this all ripple out into the Taiwanese economy itself? It's not just about his Apple stock, presumably.
No, absolutely not. That's a really critical connection to make. Taiwan's economy is incredibly reliant on exports to China, especially in semiconductors and electronics, the very things Apple needs.
How reliant are we talking?
Around 40% of Taiwan's total exports head to China and Hong Kong. So a Chinese hard landing, that would hammer major Taiwanese companies like TSMC, which makes Apple's chips, and Foxconn, which assembles them. That slowdown would hit Micky's broader investment portfolio if he holds Taiwanese stocks, and it would impact the entire Taiwanese economy.
Right, it's a direct hit.
And there's that geopolitical angle again, specifically for Taiwan. If China's facing severe economic problems, some analysts worry they might, try to distract or consolidate power by increasing military pressure on Taiwan. That adds a whole other layer of risk and uncertainty for Taiwanese investors in the economy. You'd likely see big drops in the Taiwan Stock Exchange, the TAIEX, especially in those big tech stocks. So Micky could feel it from multiple angles.
Yeah, that makes sense. So the shock waves from a potential Chinese hard landing, they clearly go way beyond just Apple. What are some of the other major global consequences we might expect?
Oh, the impact would be incredibly widespread. Take electronics and semiconductors generally. Reduced demand from China hits that whole global supply chain hard, companies like TSMC, sure, but also NVIDIA, Samsung, everyone involved.
Okay.
And China also accounts for something like 30% of global investment in semiconductor equipment. So a hard landing there slows down the expansion of chip-making capacity worldwide.
Right, slows down future growth too.
Exactly. Then you look at the automotive sector, new energy. China is the world's biggest car market. So companies like Tesla, BYD, all the global automakers, they'd see sales drop significantly. And that affects the upstream suppliers too, like for lithium batteries, where China consumes maybe 55% of the global total. It just cascades.
And it wouldn't stop there, right? Thinking about basic materials, consumer goods.
Precisely. Commodities. China consumes enormous amounts, like half the world's steel, 40% of its copper, 60% of its coal. A hard landing means demand plummets, prices fall, and that hammers countries that export those resources. Australia, Brazil, Indonesia, many others. Luxury goods, other consumer brands, think LVMH, Nike. China's a massive, massive market for them. That gets hit hard too. And just generally, you'd expect major disruptions across global supply chains and trade flows, especially in things like electronics, textiles, machinery. Countries that rely heavily on Chinese parts and components, Vietnam, Malaysia, others, they could see their own production lines halt if they can't get the inputs they need.
It really highlights how interconnected everything is. What about the direct impact on the U.S. beyond just Apple and the tech sector?
Well, the U.S. being a major trading partner would definitely feel it across the board. We talked about the tech supply chains and revenue hits. U.S. semiconductor firms could face potentially like $30 billion a year in lost sales from reduced Chinese demand.
$30 billion?
Yeah. U.S. farmers could see demand fall for agricultural products like soybeans. Financial markets, as we said, would likely see significant volatility. And again, that potential for increased geopolitical tension is always there. So yeah, the impact would ripple through various sectors of the U.S. economy.
And we touched on Taiwan's close links already, but just to sort of summarize the broader economic risks for them again.
Yeah, for Taiwan, beyond the hit to specific giants like TSMC and Foxconn, you'd see a major blow to their overall semiconductor and electronics exports simply because China is such a huge customer. Demand for Taiwanese intermediate goods used in Chinese factories would fall. Taiwanese companies that have invested heavily in mainland China would face risks to those investments. And always looming is that heightened geopolitical risk if China's economic problems worsen. That close economic relationship cuts both ways. It brings benefits, but also creates these significant vulnerabilities.
Right. So pulling this all together then, it really sounds like a Chinese hard landing isn't just China's problem, not by a long shot. It could send these huge shockwaves across the entire global economy. And the consequences for companies like Apple and therefore their investors, like our friend Micky in Taiwan or anyone holding the stock, could be really quite substantial.
That sums it up pretty well, I think. The fact that such a high percentage of Apple's production is still based in China, even with these diversification efforts underway, combined with the ongoing trade frictions and China's own economic fragility, it definitely creates a precarious situation for Apple, for its stockholders, and frankly, for a big chunk of the global economy.
It certainly does. It really leaves you thinking, doesn't it? Given all these interconnected risks, how should individuals, how should companies really be thinking strategically? How do you prepare for potentially massive shifts in the global economic landscape like this? And maybe, what vulnerabilities are we not seeing? What's being overlooked in this incredibly complex, interdependent world we've built?
Those are the big questions, aren't they?
Definitely something to mull over as we navigate these pretty complex and uncertain times ahead.
This has been Joe
and Sunny
with the Deep Dive. Catch you later.
Yeah.